Hi everyone, this is Brian Neal with TradeToBeFree.com and InvestBeFree.com. Today I want to go over the 2020 performance so far with the 3 Stocks to Wealth service, and want to also go over some of the advantages of the strategy and how we're maintaining an edge over the past couple years. We're having another great year for the service, and performance has been really strong and has been also for the first 8 years. And I want to share with you some of the tips and techniques that we use to get that outperformance, and also talk a little bit about the differences between the Trade to Be Free strategies on TradeToBeFree.com and the InvestBeFree.com 3 Stocks to Wealth service. Okay, and I just want to point out too that we are a member of the Better Business Bureau. We have an A+ rating with them. That's the highest rating, and we have been with them for about 14 years now, since 2006. With TradeToBeFree.com, and we launched InvestBeFree.com and this strategy back in 2012. Okay, so why listen to this? Well, again, clients were able to crush the market and all the best performing investment newsletters and aggressive funds out there since inception in 2012. And the great thing about the strategy, it only takes 15 minutes per week executing and managing trades. Okay, a lot of people like the service with TradeToBeFree.com and they just don't have the time and they don't have inclination to use technical analysis and learn technical analysis and all the rules in the strategy. So this was designed because a lot of customers were just buying the stocks on Monday or Tuesday after the weekly update. Okay, the weekly alert came out, and then holding for another week or 2 weeks after that and just kind of ignoring the technical analysis aspect of it, and that had mixed results. And I was curious to see if I could help those customers do really well with that sort of strategy where you just buy 3 stocks or 4 stocks and hold those for a week, revisit the market and all the top stocks at that point, and then find the 3 stocks, the top 3 stocks at that point that are most likely to trend higher and continue on their trek higher over the next week. Okay, so trying to find a very efficient, very simple strategy for those folks that just don't have the time or just don't want to get into technical analysis and learn the rules and ins and outs of the strategies on TradeToBeFree.com, and yet still have a good shot at outperforming the market and making really good returns over the long term. What we're seeing now is that all the online brokers out there are dropping their commissions or have dropped their commissions to zero. Okay, so one thing we say in the performance chart is that it's before commissions and fees. Okay, and commission costs have historically been a good chunk of the returns for smaller accounts, small and mid-sized accounts. So let's say you're starting with $20,000 and you're paying $750 per trade. It usually varied between $5 and $10 with most online brokers for years there. So I put an average of $750 per trade. If you're swing trading or day trading, you're going to have a lot of commissions throughout the year. Well, guess what? Now that commission cost is gone. Okay, so trading is now essentially free, and that's going to give you a 6% boost in your performance each year. Okay, so you don't have those commission costs anymore, which is great. Okay, so even smaller accounts have a good shot now to outperform the market with this strategy. Okay, so again, it takes just 15 minutes per week, 1 day per week. It's all about just holding the top 3 stocks each week, adjusting the portfolio in your trading account on Tuesday. Okay, so it comes out Monday evening. All right, with a list of top 3 stocks. The stocks coming off the list get sold. The ones that are being put on a list, you buy those, and we tell you exactly how to do it. It's very straightforward. There's no guesswork at all. Another reason why you should listen to this is that the clients that we have and we've had since going live back in April 2012, they were able to turn $30,000 into nearly $500,000 in just over 8 years before commissions and fees by following the simple 15-minute per week instructions. Okay, and it's very easy to hit the prices, to get the entry prices and exit prices that we have on the performance chart. We do it all the time when we use a strategy ourselves. So it's a very powerful strategy. It's been working for a long time, and I think it will work in the future too. So, okay, so we want to talk more about how we're able to do that and how we're able to set clients up to make 30% already in 2020. Now, of course, it requires you to follow the 15-minute routine each week. Some people get nervous, or they, say, I don't want to trade this week. It's too much volatility, or whatever. But for those that stuck with it and were able to do it every week and stuck with it throughout the ups and downs this year, have had another great year. Okay, so that's a pretty amazing outperformance this year, and since inception, turning 30,000 into a $500,000 since 2012. Okay, I'm going to touch on also algorithms, AI, and machine learning, and how it may affect this in the future. A lot of people are concerned about that. They're always wondering about, the AI and the machine learning. What does that mean to a strategy like this going forward? And I'm going to talk about that here later in the presentation. And also I want to tell you about what's working now for us. And, it's always a good thing to know when trading. If you can talk to other traders or hear from other traders what's working for them, you can get a lot of key insight to know, how to adjust your own trading and what to look for in your own trading opportunities you're looking for, whether you use this particular strategy or not. Knowing what works and picking up key tips over the years is what can make all the difference in the long term. I've noticed that in my own trading as I've gotten better over the years, and it can definitely lead to becoming healthier or wealthier and happier, which can help your health too. Okay, so TradeToBeFree.com versus InvestToBeFree.com. What's the difference? Well, TradeToBeFree.com has a very technical component to it. Okay, there's technical analysis that's used to find the setups in the first place. Okay, but also to trade the stocks, and that's what's different. Okay, so the technical analysis is used to pinpoint the entries and the exits. All right, if you just jump in on those trades, and we keep telling people to wait for the entry point to get triggered. It's usually when the price goes above a key resistance, whether it's a bottoming pattern or whether it's a momentum trade or breakout. You want to see the price break a key level of resistance using those strategies. Okay, there's almost always that component to it in each of the trades. Okay, and on InvestToBeFree.com, that's different. All right, so what we're doing on InvestToBeFree.com is we're finding the top 3 stocks in the market with the best fundamental and technical qualities. We go through hundreds and thousands of stocks every week, and we sift through those and find the very best ones that we think have the best chance to move higher over the next 5 days. Okay, and it's really straightforward. You just log in on Monday evening, you put in your market order to sell stocks coming off the list of top 3 before the next trading day starts. Okay, so just put a market order in anytime after hours on Monday. That order fills at the open on Monday or Tuesday morning, and then you enter a buy limit order to buy the stock coming on the list the next day. So it's really straightforward. And by the end of the day on Tuesday, you have our top 3 stocks that you hold until the next update. And these stocks are quality investable stocks that people routinely buy and hold anyway. So if you're not afraid of buy and hold, if you're not afraid of buying and holding a stock for a while, you shouldn't be afraid of buying and holding these for a week while things are going well. Okay, so, but instead of using technical analysis to time entry and exits, you just adjust your account once per week. So you have the 3 top stocks for the rest of the week until the next update, which is the following Monday evening, or actually the first trading day of the week, which in some cases is Tuesday, like it will be this week since we have Memorial Day on Monday. Okay, now what are the advantages of this strategy versus the technical strategy on TradeToBeFree.com and any other strategy for that matter? Well, the big one that I see is that with good technical strategies, you don't capture the gap often. If there's sudden good news in the market, in an industry, for a stock itself, the stock gaps up and it gaps up without you. Once the pre-market action goes, after the new day starts to begin in the pre-market hours, you've got that gap and you've lost that gap. So sure, yeah, you can look at the news and say, oh, this is great news. The stock should go higher and jump right in. But you still got that gap that we missed, okay? So it's easy to lose sight that, with all the bad news in the world right now and throughout history, it's always harped on. It's always, people are trying to, protect other people and say, you got to be careful out there trading and investing. You want to be careful. This could happen, that could happen. And, oh, this is terrible. And, oh, we have fiat currency, even though we've had fiat currency for 50 years, yada, 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 right? But there's also good news out there that happens as well. I mean, companies and policymakers, I believe, and I think, most, reasonable people would believe too, is that they're trying to find a way to improve the economy and trying to find a way to improve business, and the Fed's doing the same thing. And sometimes good news comes out. I mean, it might be the Fed, it might be the central banks across the world, it might be other policy changes in Washington, it might be a tax cut, it might be deregulation, it might be some key policy change somewhere, it might be an industry shift, a new discovery, new innovation in an industry, new IPOs coming out. All sorts of things can generate gaps and that good news. And if you're sometimes when you're using technical swing trading techniques, you're not in the market as much when that gap occurs. Okay, and that's where this really helps out, because if you're in the 3 top stocks in the market and you've got that good news that affects the industry or the overall market, you're going to capture most, if not more, of that gap higher and that initial surge the next day. So that's the primary reason why it's so effective. And the advantage, of course, it takes a lot less time, as I was saying, and it's a routine. It's a once a week routine on every Monday or Tuesday. Monday evening or Tuesday morning, you put in the sell order or orders, and then you put the buy limit order in there, and then you check at the end of the day. If it doesn't fill during the day, then you change it to a market order before the close to buy the stocks coming on the list. So that happens every week at the same time, every Monday evening and Tuesday. Okay, and to execute it, the strategy, it only takes 15 minutes. It's really straightforward. And you can beat the strategy using the technical strategies taught on TradeToBeFree.com, especially the high tight flag strategy this year, which is really hot right now. We've got a lot of high tight flags setting up in the market all over the place right now. So it's an exciting time to be in the market. Of course, the stock market always forecasts ahead of time if a recovery is around the corner. And right now, the market is telling us that, there's a good chance we'll see a pretty good rebound in the economy later this year. And that's why we're seeing all these high tight flags set up and all these really good stocks set up these bullish patterns. So you can use those strategies and actually beat this 3 stocks to wealth strategy, but it does take much more time. It takes diligence each day and an understanding of technical analysis and some practice. Of course, the better you are at it, the better you'll do. It can be time consuming and more difficult for a lot of people. Okay, and a lot of people just don't have the time each day. We're all busy with work, housework, family obligations, hobbies, interests, and we don't necessarily want to spend all day trading. This strategy can be used easily without interfering with your job. So it's taking all that work and all that time throughout the week, condensing it down to 15 minutes for you with the service. And if you have a full-time job and a smartphone, you can do this very easily with minimal interruption of your full-time job, if at all. Okay, so very, very straightforward. And it's really why I developed the strategy back in 2011 and launched the site back in 2012. A lot of people wanted a simpler way of trading, and they were thinking, oh, these are great stocks. I can just buy and hold these stocks. I'll just buy them on Monday in the Trade to Be Free alerts, and I don't care about all that technical analysis, mumbo jumbo. I'll just buy the stocks. They look great to me, and I'll hold them for a week and do it again. With those type of opportunities, it's really important to wait for the stock to hit that technical entry point and begin the trend and have the signs there that it's going to do that well, that morning of before you jump in. But this strategy is actually designed for that way of trading the market. Okay, it's sort of a portfolio approach to swing trading where you always have the top 3 stocks each week, and once a week you revisit the market and all the top stocks in the market, and you ask yourself, are these the top 3 still for the coming week? What are the trends? Has there been any trend changes? Are there any bearish signs? Is there any bearish news that's come out? What are the estimates? Are they trending higher still or not? Are there other stocks that are better? Can someone or some stock knock off another one in the top 3 list? Okay, that's really essentially what you're asking each week. That top 3 list is adjusted every week. Sometimes it doesn't change. We've had like 3 weeks in a row now where we've had the top 3 stocks the same as the prior week. And so you have some weeks like that where you'll have to do nothing with the service to use this strategy. Okay, some weeks there's nothing to do. You just hold on to the same 3 stocks until the following Monday evening. Okay, now why not do buy and hold versus the 3 stocks to wealth strategy? And I just touched upon a lot of those reasons there. Buy and hold generally refers to buying and holding a stock for years until your thesis changes. Okay, so buy and hold generally means ignore technical analysis, ignore the trend, in the stock and just hold it and see if things work out the way you think they will. Years later, regardless of if anyone believes you now, if any big money fund manager out there is seeing the world the way you do, the stock may be dropping and no one else sees what you're seeing, and you're assuming that you're smarter than everybody else and it's going to work out in the long term. And sometimes that can work. Things can change and suddenly the outlook gets a lot better for the stock and you may be that brilliant, but usually not. Usually if you look at a stock that's in a long-term downtrend for many, many years, I've seen it over and over again where I've tried to guess the turning point, and usually you're off until you're at least above a rising 200-day moving average or have a really good base pattern developing and some really strong news, positive news in the future, in the relatively near future. So that thesis that you have, it will be challenged along the way. It always is, okay? There's always some bad news that'll come out at some point, some missteps, an earnings miss, earnings downgrade, contract loss instead of a contract win. You name it. There's going to be little bumps along the road. So you got to figure out when that thesis is no longer valid. Okay, and that's a very subtle thing to pick out, and a lot of people don't do very well at that. And so what happens often is that the insiders and the people that are really close to the industry will see something, and the really big money will see that too, and they'll start scaling out of a position, and it'll go down, 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 and you never know whether it's just stock trending low for now that's going to turn around at some point, or if it's the beginning of the end. So that buy and hold approach really requires you to hold on to a 20% loss, 40% loss at various times throughout the time that you hold the stock. Okay, often on multiple occasions. And you could wait 3 to 5 years, and then after that, you turn around and you're down in your position, still waiting for that big turnaround and waiting for things to turn out your way, and it just doesn't. Okay, so that's often what happens with buy and hold, and people say, well, just buy 3 carefully vetted stocks over the long term, or 5, and a couple of them will work out, and 1 or 2 of them will be okay, and 1 will be a disaster, and you'll be all right. Well, yeah, you can do that, but your returns after adding up those 5 stocks is not going to be very good in general. So the 3 stocks to wealth strategy is basically saying, okay, that's a fine approach, but instead, let's get a basket of hundreds of stocks, find the top 3 in any given week in terms of fundamental momentum, okay, the business momentum, all right, and the technical momentum, and let's hold on to the top 3 for that week until another top stock, supplants it in the top 3 list, okay? So some other stock has to beat it that week in terms of the technical trends, the technical factors, and the fundamental factors, both, okay? And we look at both carefully to get to that top 3. And if it's still in the top 3, you hold on to it. If it's not, then you switch it out to the other one that made it into the top 3 list. Certainly not perfect, but we don't, sit there and watch it go down 10, 20, 30, 40%, before deciding whether we should get out with a huge loss or hold on. Okay, so we're not going to do that with this strategy. And so, we can see that over time, this is very, very effective. And, like I said, anything can happen to a company in a rapidly changing world. All top growth stocks will eventually go from a growth valuation and a growth phase to a more modest, slow growth phase. Okay, so they'll reach that terminal rate of growth. That's what they call the terminal rate of growth, and that might be 5% a year or 10% a year in earnings growth, or whatever they deem will happen in the future. Okay, but once it gets out of that growth phase, or when the writing is on the wall that it's about to leave that growth phase and go into a more modest growth phase, the average drop for a top growth stock is 70% from the highs. Okay, and this is the average, and some drop a lot more. And of course, this can happen at any time, and sometimes you don't see what's going on. It's usually competition. There's a lot of competitive products and services out there, and another one will come along, and if it's good enough and if it's marketed well enough, it'll eat into the sales and the margins of that company. And that's one of the things that growth stock investors look for, is they look for that those margins to start to erode. That's one of the canaries in the coal mine, so to speak. So they don't want to see that. Don't want to see those margins dropping as it's trekking higher over the years in terms of the stock price and the sales and earnings, because that can really turn that around, and you could see the stock going down quickly after that. Okay, so but a lot of times you won't see those warning signals, and what you will see though is that you'll see it on a stock chart. Okay, you'll see the technical warning signs on a stock chart. One of those signs is higher volatility. Okay, that's one of the classic signs of a top, is a stock that gets really volatile suddenly. Maybe it'll break a long-term uptrend support, or it'll just start trending lower. And if it's trending lower, we don't want it. So that's the philosophy behind the strategy. And it's a trend following strategy for sure. And again, it's very effective. We don't want to be in stocks that are going lower. Okay, now I just want to be clear too that buy and hold can work if done very well. So I don't want to discourage anybody out there for doing that if that's what you love to do and that's what you want to do. Okay, but if you look at top performing fund managers who have to buy and hold, okay, their fund rules say they have to have a certain level of turnover and they can't exceed that. So they'll tend to buy and hold stocks for a long period of time. Okay, and they also have to scale. They don't tell you this, but they have to scale in and scale out over time. And so they miss out on a lot of the move, as they're scaling in, and they're losing too on the way down as they're scaling out. Oftentimes, because they have so much money to invest, they can't, pinpoint those times where they, they want to get out quickly, but they can't. Okay, because they just have so many shares to sell, and if they sell it all at once, that's going to force the price down. All right, that's going to overwhelm the demand for the stock at the time, and you're going to see the price drop quickly. So they have to scale in and scale out over time, usually weeks and months. And another problem they have, of course, is they have to hold on to stocks for years, and really stocks tend to trend higher during narrow windows of time during the year out of good consolidation patterns. And at least that's what I've seen over the years, as long as the fundamentals are turning upward as well. Fundamental factors are turning upward as well. Okay, and if you look at the top performing hedge funds of all time, the Medallion Fund, let's say, I don't know if that's the top performing hedge fund, but it's one of the top performing ones. They use a strategy where they trade stocks and other instruments and hold it for a few days very often. Okay. Now, after fees, their long-term average return is a little more than the 3 stocks to well service. I think I read somewhere where their long-term performance was like 60 or 70% per year, but then they charge 40% fees on top of another 5% standard, off the top fee every year. But they have billions of dollars to invest. What they have to do is they have to actually use leverage to get that kind of return with that much money and that many instruments they have to buy. If they buy too much of one instrument too quickly, they're going to push the stock higher or lower, and that's going to ruin their performance. So I think they limit their fund to like 10 billion now. And it's really amazing they can do as well as they have with that kind of money. That's really incredible. Hats off to them. But after the 40% fee and the 5% fee and everything else, it's about the same as a 3 stocks to well strategy, but it's a closed fund, and you have to work for the company to get into the fund. And I'm not even sure if they can even pull that performance off anymore now that they have $10 billion. I don't know. But they have to use that leverage to get that return too, which always introduces some level of risk. Okay, whereas the 3 stocks to wealth strategy doesn't use any. We use no leverage when we buy those stocks. And this brings me to one of the biggest misconceptions in the world of investing and trading. I mean, everyone thinks this. No one tells you otherwise, and I think I know why. It's easier to make a higher rate of return with a small account than a large account. People think it's just the opposite. And if you ever have the opportunity to work for a hedge fund and you are ordered to buy or sell $100 million worth of stock and get out right away, all at once, with a stock that's trading a few 100,000 shares a day, and just sell it all at once, you'll know what I mean. You'll see it firsthand. That people touch upon this too, and you really can't pinpoint those ideal entry points and exit points when you have a large fund. Okay, you get into the billions, and it's really tough to beat the market. You also have to have, of course, a lot of stocks, and there's really only a handful of stocks that are really prime at any given point in time. I've noticed over the year that have a good shot of making a real outsized return, while not, being a penny stock or some really risky, volatile stock that could go up 20% in a minute and down 20% the next minute. So if you look at reliable, good growth stocks that make big moves higher, they only make those moves during certain times of the year, and there's only a handful of really good ones that are really poised to do well in the weeks ahead. Certainly not 50 or 100 of them in most markets. Okay, so my point of all this is that if you're a good swing trader and using a good strategy and a smaller account, don't be intimidated by, hedge funds and larger market participants. You have an edge, okay? You actually have an edge over them, especially now that you pay nothing in commissions, okay? So the playing field got really level recently now that you have no commissions. So it's a great opportunity, I think, to learn and become really good at a trading strategy, either swing trading or even day trading now that we have zero commissions. But again, you have to be good first. You don't want to jump in without knowing what you're doing and practicing and making sure that you're proficient enough at it and good enough to make money consistently. So just want to be clear about that. If you're not a good trader, trading's not a good idea with penny stocks, forex, options especially. If you're picking your own stocks to trade, trading a proven technical strategy and just jumping in with a live account is not likely to go well also. Okay, so you may watch somebody else do really well online somewhere, and you may think, oh, I can do that. I just jump in and buy here, sell there, no big deal. And you find out that, very often these are, especially on social media, there's a lot of penny stock front running operations, basically, where a lot of newbies go in the chat room and they just jump in after you call out the trade, and whoever's running the chat room, they sell as the people are jumping in. They get out at a higher price. They get in first at a lower price, and they're getting out at a higher price, while you're getting in at a higher price and then getting out at a lower price and losing money, and you're like, what's going on? So any new strategy you learn, I don't care how good it looks, my advice is to use a simulator and paper trade and prove that you can be consistently profitable with it. Okay, I would say definitely look into that, especially with penny stocks. Just to say that there's a lot of dubious penny stock strategies, if you want to call it that, out there. And if you have a low float stock, you can push it up. It can jump up 10% and then drop 10% just as fast right away. So that's a tough game to win. And if you're not the one pumping it and dumping it, then you're probably, you may be out of luck. So, and if you don't believe me, you can look at the reviews and the honest reviews out there of these different penny stock strategies. And, you've got to, really go in with your eyes wide open and be careful out there. No matter which strategy you use, I don't care what strategy you're using out there. You want to make sure you understand it, you're good at it, it works for you and not just someone who's pumping and dumping. So what we do is we feature the stocks first. We publish the three stocks Monday evening. We say, okay, these are the three stocks that we're going to buy. This is how we're going to do it. And we don't buy them until the next day with everyone else. Okay, so we tell you which three stocks we're going to buy. Or if we already have two of them and we're changing one in favor of another one, we'll tell you, okay, this is a new one. You sell the one coming off the list, buy the one coming on the list. And we tell you ahead of time. All right, so there's no front running, low float penny stocks or any of that nonsense to get a good rate of return. Just very straightforward, honest service where we tell you the stocks ahead of time and we're getting in and out with you. So, but no matter what strategy you use, like I said, use a simulator. Simulator technology has really come along strong in the past 20 years, and now you've got free simulators out there, and take advantage of them. Thinkorswim has a really good one. We've got a blog post on TradeToBeFree.com that goes over that and tells you about the features and how to use it and so forth, and that's a great resource to begin. Okay, so while you're learning a new strategy, though, you can use a 3 stocks 12 strategy with no technical analysis experience, okay? And if you subscribe and you let us do the work in finding the top 3 stocks each week. And also keep in mind that the Trade to Be Free strategy is inherently different because the stocks are not trending yet. I touched upon that before, but I just want to remind everyone of that. Okay, that the 3 stocks to wealth, those stocks in that strategy are already trending, okay, and are stocks you can hold for a week more comfortably. Sometimes you get a high tight flag breakout on a stock that, well, maybe you're better off using technical analysis and having it stop in there, fairly tight stop in there, and it's just a better fit for a technical trade. Okay, other stocks are stocks that are great stocks, have been great stocks for a long time. They're on a massive long-term uptrend, and everything's going along great, and it's great for that 3 stocks to wealth strategy that week. Okay, so if you're gonna take stocks from one strategy and insert them into another strategy, you just want to make sure if you're making up your own rules and your own coming up with your own stocks, you just want to make sure it works for you and does so consistently over the years. Okay, here's the latest performance chart. Some of you may have seen this. I looked at some of the numbers recently, and it looks like it's up another 5-10% since this. So, it's up over 30% for the year. We had this massive correction in the market. Drawdown this time was a lot less in the market, which is great. And then it really rebounded very strongly into new highs here. And you can see this massive uptrend that's just been going beautifully especially over the past 5 years. You can see this is really, really nice, beautiful chart here. I'm going to touch up on this in a minute, but you can see the drawdown over the past few corrections have been less than prior corrections, especially using this buy limit order approach, which is better during the corrections. And when I say that, I'm talking about the drawdown versus the overall market. And you can see that in here in I think it was late 2018, early 2019, when we had that really strong correction starting in, I think it was October, November, ended just before the new year of 2019, okay? We can see that the drawdown here about matched the overall market. The S&P 500 is down here. That's the black line. You can see that the S&P 500 hasn't really gone anywhere the past couple of years. When you get these drawdowns, if you could blow this up, you could see the level of the drawdown here. But these levels of drawdown percentage-wise versus the overall market were a lot better than prior drawdowns. And this latest one here was actually less than the overall market. The Dow came down, I think, 40%. And the S&P 500, I think, drew down 35-40%. And the small cap Russell 2000 came down almost 50%. I think it was around 45%, actually. Okay, so I want to talk about why that is now. And that has a lot to do with the fact that large caps led small caps for so long. Okay, during that period of low unemployment, and when you have those late cycle indicators, you often have a market that favors large caps. Earnings growth went negative for small caps, while they were about flat for large caps. Okay, so that's going to help the large caps perform better than the small caps. All right, and we have that increased market volatility after a long bull run in the market. Okay, and that makes investors nervous. They think, oh, this must be the beginning of the end of the cycle, so we're going to get a little safer now. And a lot of people who missed the first few years or 5-10 years of the bull market, they'll go in late, they'll jump in, and they feel like they missed the big run, and what they'll do is they'll tend to go towards big brands and large caps, and money piling into those areas of the market will push those stocks up. So that's part of the reason for the outperformance there also. Okay, so we focus more on large cap growth stocks, and when you focus on the large cap stocks versus the small cap stocks, that tends to reduce volatility, and that's a big reason why the volatility was so low. And over the years, we've just gotten better at handling corrections and seeing the signs that they're about to happen and what to do next. And so that had a lot to do with it too. Okay, so why is it done so well in 2020? That's the other question that we should be asking too, is that, why is there such a divergence here between the S&P 500 and especially the Russell 2000? I mean, the Russell 2000 is down, which is a small cap index, is down 19% almost for the year, and the strategy is up about 30% for the year. So that's like a almost 50% difference. Okay, and that's pretty impressive. And this was due primarily because we chose those more defensive industries early on in the correction, and we kind of saw it coming. Once Italy was having problems and they're starting to shut down. Before then, people were thinking, oh, South Korea is handling it really well. It won't be that bad. And then Italy started to blow up pretty bad, and they started to shut down businesses, and it was spreading. The pandemic was starting to get going here in the U.S. too. So those early signs led us to believe that, hey, we have to be more defensive at this point and focus in different areas of the market. Okay, and then on the other side of the correction, we had this big outperformance in April and May, and just soared into new highs. And a lot of that had to do with the fact that the stay-at-home economy was doing so much better than the rest of the economy. Okay, you had two very divergent areas of the market, where in one area you had stocks that were growing pretty quickly and they had really good secular tailwinds and strong growth in these stocks for a long period of time, and then all of a sudden, some acceleration of growth in those areas as people were forced to go online to shop and for entertainment and stay at home for pretty much everything that they needed. Okay, and you could see that in the rising estimates, and you could see that in strong, consistent growth. Okay, so it's definitely a stock picker's market in 2020. But you can see that in the estimate revisions. Okay, you can see that in the actual numbers that are coming out, the pre-guidance or the early pre-announcements that come out, and analysts coming out and raising estimates. You can go outside and drive around and see that the grocery stores are ransacked and there's nothing left available. I mean, these signs that these companies have overwhelming demand despite other areas of the economy that are just falling off. That's a big reason why we had that outperformance versus the overall market indices. And we did a good job of spotting those technical trends and those technical consolidation patterns, and stocks moving out of those strong basing patterns after the market confirmed a new uptrend in, I believe it was early April or late March. So that really helped us to immediately go to those top growth stocks and look around and ask ourselves, okay, which stocks are likely to do better in the months and years ahead. And it makes sense that a stock that provides services for diabetics, when you need to monitor your diabetes more closely, most likely, and you want to be on top of that because that's a risk factor for the virus. So why wouldn't that stock do well out of a strong base pattern? It didn't pull back as much during this correction, and it had a great long-term trend for years. It was one of the best growth stocks for many years. So it just makes sense that stock would do well, especially if the technical signs are showing strength and there's no drop in estimates and no apparent problems in the forecasts for the future. So spotting those best technical patterns and the long-term trend leading into it. Okay, so we don't want stocks that are suddenly doing well, but before then they were just not doing very well for years. You don't want to find that. You want to find stocks that have been doing well for many years and been trending higher for many years, and all of a sudden they've got another boost, based on what's going on in the world, and they have more demand for their products and services. Okay, so those best technical trends that are poised to do well in the temporary stay-at-home economy. And I say temporary because, with a question mark there, because this may last a lot longer. It may not. Okay, so we may have a vaccine later this year. It might be next year. It might be never. We might have a therapy later this year, next year. Who knows when this temporary stay-at-home economy will end? But it could be, it could be a year, it could be 2 years. We really don't know, but the technical signs and the fundamental signs will emerge, and we're looking for that big headline that says that we've got a vaccine or we've got a cure. And at that point, then I would expect all the travel stocks and all the other stocks that have been hit really hard by the pandemic to turn around, and the stay-at-home stocks to come back to a more reasonable valuation. And so what about the remainder of the year then? What can we expect? And what are the trends right now? And what we're already seeing is the survivor bias among consumers. Okay, so those companies that have the big brand and the balance sheet and the ability to withstand this pandemic and survive are already doing better. So, while some restaurants and retail stores and other businesses will file for bankruptcy or be purchased, a small percentage, small but good percentage of that sphere, in those various industries, will probably go under, and the other top companies in the space that can withstand this downturn, this really rough spot for them, are poised to be really strong on the other side of this. So after we recover and after more people go to restaurants, Chipotle, for instance, will have a lot more customers because there'll be less competition. Okay, so investors know that, and that's why Chipotle, even though it seems richly valued, is breaking out of a high tight flag and is soaring into new highs. And we're seeing the same thing with Lululemon. Of course, Shopify broke out of a high tight flag last week. So we're seeing these very strong patterns on these stocks that can survive through this, get to the other side, and take more market share and do really, really well and post great numbers after things recover. Okay, and what can we learn from the biggest winners so far this year? It's always good to go back and learn not only what's not working, but what is working. Okay, and we can see that some of the biggest winners this year were DocuSign, Quidel, Amazon, Dexcom, Regeneron. We caught some of these stocks coming out of really nice base patterns, and they just soared 20, 25, 30% within a week or two, and we got in, we got out, booked a really big profit, and went on to the next stock. So, but a lot of these stocks are overshooting those standard projection targets. So you would think that they'd be overextended and ready to pull back. But, these top growth stocks can go on these massive runs, and you wouldn't think with everything going on that they would, but you're talking about, again, stocks that can withstand the turmoil and the financial hit and other potential problems, and they're growing very quickly ahead of this, and now they're getting a boost because their services and products are more needed, so they can run and go a long way and really just go into a consolidation, a more narrow consolidation, and maybe do it again, break out and do it again, weeks or months down the road. So we're going to keep an eye on all those, like the Teladocs of the world and Livongo. Another good stock we had in the alert service on TradeToBeFree.com. We mentioned Fiverr in an explosive bottoming pattern before it doubled in price recently. Twilio was a great earnings eruptions trade that is already up 30% from the technical entry point within a few weeks. DocuSign, Lululemon. These stocks can form good consolidation patterns and break out again. And especially if the lockdown measures continue in a lot of areas, they could easily come back in the fall and winter. Okay, so they could continue to do really well the rest of this year, and we'll have to wait for the next consolidation and good entry point in a lot of cases, because we don't want to chase them too much as they've have gone up a lot. So some of these are starting to show signs of the next consolidation. But it all depends on the economy. If it continues to recover, and if lockdown measures continue through the summer and or come back in the fall, okay. But these are all stocks to watch, even though they've run so far. Okay, now of course, if we get the vaccine announcement that it's been proven as safe and effective, one of the vaccine manufacturers, I think there's 20 of them that are in trials, well into trials at this point. So if we get those kind of headlines that we have a vaccine that really works, and right now we're not going to know until you get that stage, phase 2, phase 3 trials, and really the white writing is on the wall that one of these is going to be effective and safe and will be used on an emergency use basis right away, and that will be a big headline that will move the market and move different stocks. Okay, so one of the questions people always wonder is, how long will a great strategy continue to work? It's been 8 years now, so will it continue to work in the future? This whole philosophy of finding the best 3 stocks in terms of the long-term, short-term, and intermediate-term trends, the estimates rising, the strong growth metrics, and so forth. Will this continue to work over the next 8 years? Okay. I don't see why not. All right. We're putting a lot of our own money into the strategy as it's more and more proven over the years. It's been great. 8 years is a long time, and now we're really into decades into the age of machine learning, AI, algorithms, and high-frequency trading, and yet it's still going strong. So people think, oh, it's all the computers that are making the money, and no one else is making the money. Well, that may be true if you're trading during the day trading or scalping quickly, or if you're trying to compete with high-frequency traders and the machines during the day. But on these longer time frames, over a week or so, really they're not really competing. There's some that are, and they're always looking at the news, I think, and other information. I just don't see how they've suddenly become so much better this year than they were 10 years ago or 15 years ago. Because believe me, they had the computing power 20 years ago and 15 years ago to come up with a great algorithm and machine learning and AI and all this stuff. It was around many years ago. Okay. And I'm sure it does have some effect on trading. I mean, I'm able to day trade and make money too consistently. So I just don't see that as suddenly being, oh, this is the year when you just can't make money anymore. I just, why? Why would this year be the year that you suddenly can't make money, and this is a year that this strategy won't work? I don't get it. I think if you had a ton of money, if you have a large fund with billions of dollars, it's always difficult to beat the market. It's always has been. Okay, but with a small account, and if you're just focusing on the top 3 stocks, the best few trades every day, and I see it over and over again, I can beat the market. So I don't see why that would not be the case this year, next year, and the year after. I just don't see it. And a lot of experts, if you talk to Warren Buffett, he'll mention that there's theoretical limitations of artificial intelligence. Okay, there are, and they think they can get past those maybe, but it remains to be seen. Okay, so I forgot what the concept was that some experts say that you'll just never go beyond. You'll get to a point where you just won't develop AI any further. Okay, and not a lot of experts will tell you otherwise because they want big investments in their companies and develop what they can with the limitations of it. But I don't know if I buy that, and I think it would have been developed by now if that was the case, and we're still doing great. So I don't know. Maybe I'm wrong. Maybe 5 years down the road it'll be completely different. But man, we've got the computing power like you wouldn't believe, and we've had that for many, many years, and all kinds of very advanced algorithms and AI applied to the market for decades. Okay, so yeah, so I don't know why it would quit working. We're on a longer time frame too. We're holding for a week to 2 weeks. High frequency traders not going to affect that. That's just going to that'll give you more liquidity to get in and out at the current market price. That can help. So, and if you look at the studies, they say that, and you can say, oh, it's just the hedge funds saying that, or the financial companies saying that, but maybe it's true. Maybe there is a benefit, and I think there is. I think there's probably a trade-off there too. You talk about dark pools, and everyone's like, oh my gosh, the dark pool. Oh, it must be evil and awful. It must take our money constantly. And I don't know. I mean, I can make money day trading. I can make money swing trading. I can beat the market. I've been doing it now for a long time. I've better this year than ever. Again, maybe some new technology is going to be like the best AI machine ever. This year, I don't know. I think they've been talking about combining AI with human intelligence. And that's what we need next. And that's the only way to take the next leap forward. And so I don't know, but I just don't see why this would be the year or next year or the year after. And the other thing I want to point out too is now growth stock and growth in general is going to be more valuable than ever because we've got a 10-year yield now below 1%. So that's forecasting lower growth going forward, and that yield may rise over time, and that can change, of course. But that's a forecast of low inflation and low economic growth in the future, and so growth stocks become more valuable. So it could do better. Who knows? I don't know. I know it's worked in the past. I know it's working now. I'm going to keep using it until I see a year, 2 years, or more where it just underperforms. But this philosophy and general strategy that I use, and my knowledge and experience gets better over time. Maybe real intelligence is better than artificial intelligence. Maybe that's the bottom line here. I don't know, but I'm going to still use it, and I really believe in it, and I think it'll do well in the future. I don't see why it wouldn't. And again, with that 10-year yield now so low, growth is going to be, more valuable than ever. And a lot of experts are talking about, 4 or 5% market returns, overall market returns in the years ahead. And that's what we have to look forward to over the next 5-10 years. And, all these top fund managers are saying this, and, maybe they have a reason to say that, or reason why they're telling you that, other than to inform you what they think is really going to happen. But we could see a period of lower growth, and that's what the 10-year yield now is telling us. And the Fed's buying treasuries, and they're supporting lowering those bond yields, I'm sure, to some extent. But it's also a market based on other factors too. And if that yield starts going up, you're going to have more buyers that want that yield if it goes up to a certain point, right? Because they're going to say, oh, that's a pretty high yield, and either I'm going to want that yield, or it's going to go down, and that bond is going to go up in value as the yield comes back down. So I don't know. I think growth stocks and this type of strategy is poised to do well going forward too. I think I want to point out too, is while I'm talking to you today, is that we're seeing a lot of high type flags developing and poised to break out. That's a very bullish chart pattern. To us, the most bullish. Okay, we're seeing a lot of really top stocks that are breaking new highs. So they're forming the pattern, breaking out new highs with more positive news, and that's a very bullish pattern. And when we're seeing so many of these stocks out there that are in this pattern, that are poised to break out and go a lot higher, that's a good sign. That's a bullish sign in the future, and good for growth stocks in general too, and the type of stocks that we use in the strategy. So if you haven't looked into the high type flag breakout course that we have, the high type flag course, it's really good. And I just looked at my one of my trading accounts where I'm doing the longer term swing trades from a few days to a few weeks or so, the whole times. And I'm seeing all the top performers are high type flag breakouts. Okay, so these are powerful patterns, and they're coming up all the time now, and this might be a time to clean up, especially if that volatility index comes down even more to a more normal range. Right now we have to give it the breakout a little more room. We have to give a little wider stop loss, but they're working really, really well overall. So that, I think, is a good sign for the overall market as well. So, be on your toes. Anything can happen, of course. We could have more lockdowns, another, more pandemic problems throughout the country and the world, and, some kind of financial hit or financial crisis somewhere in the world too is possible, I'm sure. It could cause more turmoil. So you got to be on your toes, of course, as always. But if the trend is higher and the market is making higher lows and higher highs, right now it's showing some fairly bullish signs, and the small cap index is starting to show some strength now too, and it may be ready to lead, which would be a good sign for the market. So, who knows? It may be the experts are right, and we'll have a strong rebound later this year, and we'll continue to slowly recover, gradually recover strong initially, and maybe it'll just continue on later this year too, at least to a point where we have reasonable economic growth and get out of a recession. So, it's a good time to be on your toes and take advantage of great opportunities when they come up, and have a great strategy to play the best technical trades, or to use the 3 stocks to wealth strategy, which saves you a ton of time and has been, is more proven than ever. And right now we're having a special on Memorial Day. We normally have a special around this time of year where we offer a discount for the first 3 months. So you can take $200 off for the first 3 months if you want to try it for the first quarter, and then it reverts to the normal rate after that. But it gives you a chance to try it at a discount at a time where the market is trending higher now, and we have some bullish signs out there. Certainly, some volatility as well, but it's been soaring recently, and it could continue to do well later this year. So if you're interested, you can go to the site, and I'll put a link down below the video so you can go ahead and check it out. And if you don't want to do that, if you want just a free video course and start to learn it yourself, you can do that. Go to the homepage on the site, and you can sign up for that video course, and that will begin to teach you how to use a strategy. And in general, it takes a few years to really become good at it. It took me 10 years, 15 years to get where I'm at right now in my skill levels. So it takes time and effort, and if you want to do it on your own, that's great. And those videos can help you get started. And there's plenty of other tidbits and tips that can help you along the way as well. There's a lot of things to discover and learn about in trading, and I wish you well on that journey if you decide to go that way. And if you ever get to a point where you're just too busy and you don't want to spend all the time and effort to find the top 3 stocks each week, we can do it for you. And we can do it by just signing up on the site, and you'll get immediate access to the course videos, the getting started video, and you can see how quick and easy this strategy is and how little time it takes per week. And I think you'll be really happy with performance over time and the strategy in general, and how well it fits into your schedule, which is, I think, key over the long term. All right, well, best luck in your trading, guys, and we'll talk to you again in the next video.